how much damage is this very public game of chicken over the debt ceiling doing to U.S. credibility in this region and around the world?
I think this will be one of these things where, again, if it gets done in time, it won't have done much damage. You'll have part of security markets that were a little out of line for a short period of time. I'd obviously encourage both sides to reach a decision quickly. And again, this is changing day to day. It appeared over the weekend they were very close, then there was a setback. But again, it's my hope that this doesn't come down to the wire.
I think your hope and the hope of just about everyone else. There is a lot at stake. You mentioned the importance of the US dollar as the world's reserve currency, the concept of exorbitant privilege that rests almost alone with the US Treasury Department. Do people at home, which is to say not here, I think there is sufficient understanding and recognition here and in this room of the importance and meaning of exorbitant privilege, do people back home understand how much is at stake and how advantageous an adverse outcome would be to, for example, a country like China?
Well, again, let me just say, I took the responsibility around the dollar very seriously. It creates certain advantages and it is certain responsibilities. And again, look, I think the bigger issue is really, we do have inflation in the US. It has been costly. It's led to very significant rise in interest rates. That's had an impact on the US. We've begun to see a slowdown. I think we'll see more of a slowdown, not just on the US economy, but as interest rates go higher around the world. And as I've said the last 2 years, I've been worried about inflation. I thought the models on the way up didn't predict it because of the excess stimulus. And there's no question, in COVID, we had to spend a lot of money. And I think had we not done that, we would have had a worldwide depression, not recession. But clearly, coming out of COVID, there's been, in the US, way too much spending, and that needs to be right-sized.
If the main economic uncertainties a year ago were the trajectory of inflation and, of course, the impact of Russia's invasion of Ukraine, both of which we talked about, as you survey the economic landscape today, what strikes you as the biggest unknown, call it the biggest uncertainty?
Well, I think the biggest uncertainty, I think the Fed is either done or close to being done. I think the uncertainty is how long does it take at this point to slow down the economy. I think the Fed was slow to raise rates. I think they'll be slow to lower rates. I don't think they'll lower rates until they're clear that inflation is under control. It doesn't necessarily mean they have to wait for it to get back to 2%, but it's got to get a lot closer to the target. And my own opinion is that the markets are predicting too soon of a Fed easing. So I think the unpredictability is how long does it take?
Mr. Secretary, you know a thing or two about banking. As Secretary of the Treasury, you were one of the main regulators of the US financial system, and long before you became Secretary during the great financial crisis, you bought a bank out of FDIC receivership, you renamed it, you ran it, and eventually you sold it. 4 banks in the United States have failed in the past 2.5 months, and several others are still in trouble. Having seen the industry from both perspectives, private and public, what lessons should we draw from those failures and what appears to be the fragility of the fractional reserve model?
Well, look, there's no question the US bank failures were a result of, first, management failures, and second, regulator failures. So, although there were liquidity issues, and that's always what drives banks, in this case, you had a very big mismatch between assets and liabilities. And when you run a bank, that's kind of banking 101. It's the Asset Liability Committee, known as ALCO, and you constantly look at interest rate risk. It's almost surprising to me that this wasn't picked up quicker. Look, I think fortunately, the 3 major banks in the US that failed didn't have an ongoing impact in the short term, But I think in the long term they will. And I think one of the issues we need to address is FDIC deposit insurance. I think it's way too low. I think I've said publicly it should be raised to 25 million. I don't think it should be raised to unlimited. But you have to have deposit insurance so that companies who have operating accounts know that their money's safe. And if we don't do that, we're going to end up with 5 or 6 big banks in the United States, and that's not it. So I'm very concerned about deposits leaving regional banks and mid-sized banks, and I think that will have a big long-term impact on the economy.
If your suggestion were to become part of the new regulatory environment, is that enough? Should the government and/or the arms of government, such as the FDIC, the Federal Reserve, the OCC, do other things to safeguard the U.S. banking system?
I think that's enough. I mean, I think people talk about having to change the regulations. I don't think they need to change the regulations. The regulations have been clear. And again, I think the 2 key things in banking are interest rate risk and liquidity risk.
Bank failures are supposed to have consequences. That, in theory, is what incentivizes management and regulators to safeguard the system. But I do wonder to myself about this. If banks can fail with no losses to depositors, which is what happened in the case of SVB and the others, and no real fallout in the economy, haven't we just succeeded in socializing risk, turning the government into the implicit guarantor of the financial system and created a whole new category of moral hazard?
Well, what I would say is the problem we have now is, again, in previous bank failures, there were people who took losses. In this case, the deposits were all guaranteed. The problem now is people don't know if there's another bank failure, whether the deposits will be guaranteed or not. And that's why, in my opinion, we need clarity, and that they shouldn't be 100% guaranteed. This was a warning, but on the other hand, I just think the deposit insurance is too low. But you've seen a lot of money leave mid-size and regional banks exactly for this reason, because people said, I don't want to take that risk. I'll move my money to a major bank.
Well, one other option is consolidation. America may not need 5 or 6 big banks like Canada has, for example. It could have more than 5 or 6, but it could have far fewer than the thousands it has now.
Well, we've had a lot of consolidation, but what I'm talking about are the 20 or 30 biggest banks, and the answer is I think you need to have an economy the size of the U.S. more than 5 big banks.
Mr. Secretary, the Trump administration in which you served took a tough position on trade with China, and the Biden administration, with broad support in Congress, has arguably taken an even tougher stance. It has broken with decades of precedent and vowed to defend Taiwan. It's also banned the export of advanced semiconductor technology to China. And I wonder, from your perspective, do you see the United States headed toward, or perhaps already in, something akin to a Cold War with China?
Well, I wouldn't call it a Cold War, but what I would say is, the relationships have deteriorated to the point where it is quite concerning. I'm not sure that the Biden administration on what they've done has been that much tougher, but the rhetoric has been much tougher. President Trump was very clear, and we went back and forth many times in negotiating with China to get a fair trade deal, to try to balance a lot of these issues, to try to make sure that on the national security front we put protections in place, and these things have continued. I think the problem is, as the 2 largest economies in the world, we have to be able to communicate. We may not agree on everything, but we have to find areas that we can agree and work together on, and that's beyond just the environment. I'm talking about, fundamental issues. So I think it's quite concerning where we are. I don't think a full decoupling. The other comment I would just make on China is China's population is going to decrease by a couple 100 million people over the next decade, and India is going to increase. So you're going to see dynamics in the region, and it's going to be very expensive for China as their population ages with the economic factors.
Is that to say that they are as incentivized, or perhaps more so,
I think more so.
To achieve something of a rapprochement with the United States?
Yeah, and again, I would just say there are both economic issues and political issues. Obviously, what's going on with China and Russia as it relates to Ukraine is quite concerning.
China recently brokered a historic peace agreement between Saudi Arabia and Iran. Was that a game changer?
No, I mean, I wouldn't characterize it as a historic peace agreement. I would characterize it as they've reopened relations, and I think on the one hand, that's good that they're talking. On the other hand, I think the issues associated with Iran are the same issues that have been there. The biggest concern is obviously the nuclear situation, and I think it needs to be pretty clear from the entire world that Iran shouldn't have nuclear weapons.
How do you see China's role in the Middle East evolving both financially, I suppose, and militarily?
Yeah, I don't see it evolving that much in either one of the cases. Again, I think we're a far cry from the Belt and Road days. I think China, is with their crackdown is going to have big economic issues internally. So I see it less of an economic influence. Obviously, they're a big consumer of energy, and that has an important relationship in the region.
Mr. Secretary, I'd like to end with this. China is clearly seeking more clout in this part of the world and other parts of the world. If the United States hopes to regain its clout in this region and persuade governments here to oppose the Russian occupation of eastern Ukraine, or, for example, to view China's ambitions with skepticism, if not mistrust, what should the Biden administration do? What's the recipe for success here?
I mean, I think the recipe for success is, the United States has had very strong relationships in this region for very, very long periods of time and needs to continue to strengthen those relationships. The U.S. is an important trading partner, important strategic partner, and an important military partner in the region.
I'd like to thank you very much for spending time with us here at the Qatar Economic Forum. Ladies and gentlemen, Steven Mnuchin.
Pleasure.
Please welcome to the stage His Excellency Mansour Ibrahim Al Mahmoud, CEO of the Qatar Investment Authority, Dina Powell McCormick, Global Head of Sustainability and Inclusive Growth, and Global Head of Sovereign Business at Goldman Sachs, and Bill Winters, Group Chief Executive of Standard Chartered, for a conversation with Bloomberg's Editor-in-Chief, John Micklethwaite.
Thank you very much. There are all sorts of important questions that we answer in this forum, but this one is by far the most important, which is where should you put your money? And to do that, we have beside me Dina Powell McCormick, Global Head of Sustainability and Inclusive Growth, Global Head of Sovereign Business at Goldman. We have His Excellency Mansour Ibrahim Al Mahmoud, the CEO of Qatar Investment Authority, one of the biggest investors in the world. We have Bill Winters, the CEO at Standard Chartered. Your Excellency, let me begin with you. Put simply, which part of the world do you think looks most attractive from an investment point of view? I did see you've added the amount of emerging markets from 10 to 20% of your portfolio, but which bits interest you most? Is that going towards China or maybe India?
I will try to put it simply, as you said. But as you know, market is changing right now. And as we say in English, the sea is changing. You have a higher interest rate with the rhythm of acceleration that have not seen before. You are talking about inflation, which apparently become a sticky inflation, high labor market. So a lot of changes has been happening in the market. This is, of course, will reflect into some popular asset classes that has been there because there is a tide in liquidity from the bank. So I would assume for the last 2 years, we have been very active in the credit space. Companies that has been feeling the tide, and they have a very good business models, but they have an issue.
Does that, very quickly, does that mean both private credit as well as public?
Yes. So they have an issue with their balance sheet because of this acceleration of hikes of interest rate. So normally, an institution like us, who are very liquid, very long-term, have a risk appetite on these type of investment, would be an interesting to invest in this space. So I would advise that for the next maybe 1 year, the credit space would be an interesting space to deploy some investment.
And what about regionally? Is there a particular region that interests you at the moment?
The region allocation that we have is really governed by a long-term vision that we have, whether this is for the US market or Europe or emerging. When I say emerging, I'm talking about China, India, Brazil, for example. And on each one of them, you need to have your own sort of a process and assessment to identify opportunities. So for example, the rhythm that we are investing in technologies is in China and India would be a little bit more than the rhythm that we are investing in technologies in Brazil. So each market will have its own characteristic to really identify some of the opportunities that you would deploy. But all in all, you have some sort of an allocation, which around, for us, for example, around 20% of our allocation on that particular market.
Mm-hmm. One last quick one on that. Has India now got past the Adani Group troubles? We just had a story today pointing out that the Adani Group has come back up to the same level. Do you think that has gone through?
See, we have a good relationship with Adani Group. We have invested on the electrical distribution of Mumbai. And that particular business is a private business, and it doesn't have any issues in terms of the, the liability issue that Adani Enterprise went through. Adani he's a very well-known businessman. He managed to go through the difficulties that, the Adani Enterprise went through. They managed to reduce their leverage, and I'm sure that they will go through it smoothly.
Dina, can I turn to you? You're head of sovereign wealth business at Goldman. Where are you? Is that a typical thing? Where are you seeing the big sovereign wealth funds put their money?
Sure. Well, first, I want to thank His Highness. I want to thank His Excellency Sheikh Mohammed and Your Excellency and Mike Bloomberg and the Bloomberg team for hosting us in Doha. Being here, I think you feel the vibrancy of the economy, you feel the energy, you feel the entrepreneurship, and frankly, that's because of the leadership here that's been investing for a long time, as His Excellency stated, in very important sectors and really thinking about their next generation. Obviously, sovereign wealth funds for many decades have been unique investing platforms. They're very reliable, they're consistent, and they're long-term thinkers, and that is very, very important. But they also have tended to be innovative capital providers. So when you think about artificial intelligence, life sciences, you think about green and renewable. I mean, isn't it interesting that it really has been the Gulf countries with His Excellency's leadership at QIA and other sovereign wealth funds that have really led the investments around renewable, green, and climate transition. It's very forward-thinking, and it's made a huge impact. You were talking about regions. I was telling His Excellency, actually, if you look at the US-China relationship today, and we've heard this, of course, all day, it's very complicated, and I believe likely to get more complicated, at least in the near term. I think you'd agree with that, John. And of course, Europe, we have the war going on, and Jan Hatzius, our economist at Goldman, believes that, unfortunately, there's more of a likelihood of a recession there. So the Middle East is quite an interesting investable region right now, with the price of oil where it is, and where these unique opportunities lie.
Are you assuming a US recession?
Jan Hatzius is more optimistic, actually, so he believes if there is one, it will be shorter and milder than others. But to the question, to the previous panel, I think what happens on that is very important.
On the debt ceiling,
yes.
Where you were, I should say, you were obviously National Security Advisor, all those sort of things. You were part of a White House. What would you expect to come out of this?
Well, first I would listen to Secretary Mnuchin because he's been in those rooms fighting those fights and actually did a remarkable job negotiating at that time with Speaker Pelosi. Yesterday, I think we're optimistic with how the meeting with President Biden and Speaker McCarthy went. They really went out of their way to both make very positive statements. They have negotiated already a number of the thorniest issues. I think one of the largest ones that remain is how to deal with non-defense discretionary spending, which is 14% of the US budget. And I believe they will get there. I think in this case, they need to look like each side is fighting very hard for their positions, so getting a little too much to the edge. But I also recognize in the way they're talking about it and in the way I've heard from some of the negotiators on Capitol Hill, that not only is this extremely economically damaging, there's real political cost for both sides. So my prediction is it'll get too close for comfort, but there will be a resolution.
At the very last moment. Bill Winters, I'm sorry to come to you in this capacity of pessimism, but to look at your industry, you've had Silicon Valley Bank, First Republic, Credit Suisse. The other thing, apart from the debt ceiling and the inflation, which both speakers have already mentioned, the other thing hanging out there is this idea that maybe the banking crisis is going to continue. How do you see that?
I think we're pretty much done with the crisis phase, but I don't think we're done with the need for an ongoing transformation. So every story is a little bit different, but we know that at the heart of the U.S. regional bank challenge is that many of them grew a little bit too fast without some of the conventional disciplines that are normally evident in banking. And then with regulation that was a little bit differentiated between that tier of banks and the large banks. And in an environment where interest rates increase at an unprecedented rate, those weaknesses become clear. So I think the response from the Fed in particular of extending term funding facilities to the entire US banking industry, I won't say that the entire industry is guaranteed, but it's pretty close. So I think that extinguishes the crisis. Credit Suisse was a completely different situation, obviously in trouble for some time. And while the conclusion was very surprising to me in terms of the way that the bank was resolved through this very unusual sale to UBS with associated unusual payments to shareholders versus bondholders.
Do you think that was one of the deals of the century for UBS?
Yeah, I do.
I think they got a good deal.
So we should all have owned UBS. We can start with that. Sorry, Bill, but I'm interested in one particular.
I don't think there are big. When I look at the banking industry, it's very well capitalized right now. I think everybody's looking very carefully at their liquidity profile. Thankfully, Standard Chartered Bank is extremely liquid, always has been. And I think most banks who have had consistent business models and consistent regulation are in a very good position from that regard. But weakness, as we're seeing, weakness, and I think this will go across every industry, will be exposed by this economic environment that we're going into. So I think Dina's right that we'll have a slowdown for sure. Recession, maybe mild, if so, mild most likely. But with high interest rates, and then particularly in emerging markets, strong dollar relative to emerging markets currencies, weaknesses are going to be exploited very hard by the market, and we're seeing that.
One thing which just occurred to me, because Dina mentioned it, on China, you do have the big worries about debt in China. How do you see those?
Chinese debt levels in aggregate, so it's looking across the sovereign, federal, the SOEs, and then even picking up the privately owned enterprises, in aggregate is fine. There's always a question how it gets allocated out, because there are clear concentrations of debt, in particular in some local authorities, that if left to their own devices might be difficult to serve, but looked at on a federal level, it's fine. One of the keys for China is that it continues to grow. So we're expecting 5.8% growth in China this year. It had a very good first quarter, slowed down in April and May. We think it'll normalize to around 5%. At 4 or 5% growth, the current debt level is no problem at all. If growth went down to European or even American levels, it could be challenging over time. But I think that's quite unlikely given the investments that China's made.
Can I ask you about something which I'll come back on to the other two panelists about, which is the idea of the Gulf here as a financial center. Particularly since COVID, you've seen many of the Gulf centers, Dubai, Saudi Arabia, here as well, trying to bring financial services companies here, and obviously you're both here, but especially kind of luring people from Asia. How do you think that is going?
Oh, I think it's going extremely well. So first of all, let me add my thanks to Dina's and for having me here. But the interest, as you know, Standard Chartered is very big throughout Asia, as well as Qatar and the rest of the Gulf, and everything in between. The amount of interest out of China in the Gulf is extraordinary. We've already led 3 groups of clients. We've got Mandarin speakers sprinkled throughout the region. I think this is, and it's two-way. It's both contracts and capital going both ways. So what exactly makes something a financial center, we could probably discuss all day long, but having a world-class investor, turn to the gentleman on my right, having a strong regulatory environment, and having an open economy, certainly as it relates to capital flows and as it relates to investment, those are prerequisites, and the Gulf is an absolute magnet, and Qatar is doing extraordinarily well in that context.
Your Excellency, I know you're, among other things, you're on the board of the stock exchange here.
Yes.
How do you see the future? What is your kind of vision for how this particular, both Doha, but just generally, evolves?
Absolutely. I'll start with Doha, for example. After, we hosted the World Cup, and we have built an infrastructure that was a plan to build in 30 years. We have built it in 10 years. Now the mindset is about how we could utilize this infrastructure. And the local economy is becoming the top items in our agenda. Lately, for example, we have reviewed our constitution as a QIA to make sure that we can play also as an enabler in the local market. And I think this is very important where an institution like us and maybe an investors who would like to be in the region and who would like to tap into the growth of this region, would like to create a partnership with an institution. And I know most of the sovereign wealth funds here in the region, like PEF or Badala or ADIA or KIA, all of them are playing the same role. The government in the region have been investing in education, infrastructure. We have a young leadership. And all of them are believe on really enhancing the local economy and bring prosperity to and they have everything. They have, the population who are young, willing to produce, and we have the infrastructure, and we put the legislation, and we have the capital, and I'm sure other investors from the world would like to be part of this growth, and I think the equation is win-win for all of us.
Do you think, financial services is more risky, with all due respect to Bill and Dina, and I remember I forgot you were part of Credit Suisse,
yes.
You were chairs in that. And certainly as a Briton, I can tell you that having exposure to the financial services industry in your economy isn't always a great thing. Does that worry you at all?
No, not at all. I think, the banking sector is based on confidence. Mm-hmm. And whatever you do to your balance sheet, if you lose that confidence, you are in collapse. So it is very important. If the case happened with the Credit Suisse, it doesn't mean that all of the banks have that issue. And whatever you do, I think all economies would like to have a banking system that could support them. You cannot grow, businesses, corporate, they cannot perform very well unless they have very solid banking system. So I'm not worried about this. And, we are a very mature institution. Managing the risk and expecting the risk is part of our job, and this is our bread and butter.
And in terms of going forward, when you look at this region, do you think that there is a chance that we will talk about it in the same way as we talk about New York, London, Hong Kong, or Singapore, or whatever the main centers are?
Why not? We could complement these cities. I think the globe and the population of this region by itself mm-hmm. is capable to bring another city of the size of Singapore or New York. So I'm not saying why not. It could be.
Dina, he loves you. They want you here. But you also mentioned earlier ESG, which you also head up in your many jobs. And how big do you see the green? There is this big worry about climate change and climate finance, that there mm-hmm. is not enough money mm-hmm. Mm-hmm. to make it happen. The bill is gigantic. Mm-hmm. Do you think there is enough cash?
Well, it's interesting. we certainly don't have a client that isn't focused on this issue, climate finance, climate transition, and of course now more than ever with the energy market disruption post-Ukraine. I think there's certainly more capital needed, but as we were talking about this morning, it's what kind of capital. There's investment capital, which is critical, which frankly, QIA has been very focused on this space, as we said. There's philanthropic capital, which is very important, but I think there's a need for hybrid capital. And by that, I mean philanthropic and investment capital working together. We're very proud to have a partnership with Bloomberg Philanthropies and the Asian Development Bank. In this partnership, we've worked to create a financing facility that we hope will, our philanthropic capital will leverage up to $500 billion of risk-taking capital, I guess I should say. New models, smaller companies in Southeast Asia in particular with this facility that's just, unavailable today. So for example, one of our investments was an investment in an electric bus fleet in India. Probably Goldman Sachs wouldn't have made that investment on its own, but with the use of this shared facility, we're able to invest in that company. And as we sit here today, we have heads of state, multilateral institutions, sovereign wealth funds, other investors. I think that coming together and creating more of that hybrid capital would make a big difference.
Do you now think that you've been on both sides of the sort of state and private thing. Do you think that now climate change and stuff like that is being led by the private sector more than governments? You look at the relative failure of things like COP.
Well, I actually do think that the keys to really going through this climate transition period well and thinking about advancing are investment, innovation, and leadership. And I think the private sector has all three of those and is very focused. One, because there is a huge market opportunity. This is the industrial revolution of our generation to some extent. And if we do it wisely, there's enormous capital to be gained. But secondly, I actually think that what has happened over the last year and a half has really shown the importance of energy security, energy independence, and new sources of energy emerging.
Bill, can I come to you with the other big one, which again, His Excellency and Dina mentioned earlier, which is AI. Everywhere you go, you see people being scared or incentivized by this wonderful new technology. How do you think that will change investment?
I think it's going to change a lot of things. It already is. But I think we have to be careful about the words. I mean, if you asked the same question 3 years ago, you might have said blockchain or something like that, and it was going to change everything in the world overnight. Well, of course, it hasn't. It's a useful tool. AI is also a useful tool. It will be applied to many more things than are actually artificial intelligence. That's the nature of the beast. But I think the fact that we're approaching that point of singularity where machines are capable of reasonable thought at a faster and more accurate rate than human beings, I mean, we will reach that point. Maybe we're definitely not there now, but we will. And that will change the nature of work. And I think it will change the nature of relationships. And to me, one of the most fascinating questions is, will we use AI to have better human interactions, or will we displace human interactions? I'm sure that the first will happen, and we're already doing that in banking. You're doing that in every industry to one degree or other. Various machine learning, big data models to generate better recommendations for whatever the situation may be, that's then synthesized by human beings and then communicated along with trust and commitment at a human level. I think that's going to stick around for a very long time. And I think we will make better decisions by virtue of the data. Will the machines eventually displace human beings? I think we'll have to be very careful not to let that happen. I think we might have a better set of decisions, but a very dangerous world.
Your Excellency, can I ask you on that? You have to look at investment over the very long term, and tech has been a part of that portfolio. Are you rethinking everything? Bill, I think, correctly pointed out that blockchain, 2-3 years ago, there would have been terrible bankers appearing telling you to invest in blockchain. Now, suddenly, it's AI. Do you look on AI as something that changes your whole theory of investing in tech or not?
No, it will not change the whole thing, but it is a theme that we are applying. So from time to time, we tell our teams that this is very important, this is coming. Please look at it. Make sure that we build a portfolio that that tap into these themes. The same thing, for example, climate change, digitalization, life science. These long-term themes that, in terms of the AI, I think this has been there. We have been investing in there. I think the level of using the AI in terms of the extreme where the machine would do everything, personally, I have a mixed feeling about it. And I feel that we need some sort of legislation that could manage this. But using the minor AI to help marketing, to help companies understanding their businesses, and so I think this is a wonderful technologies that we could utilize.
Do you think it offers a chance to a country like Qatar to leapfrog, to jump ahead? If you look at the way that, say, India leapfrogged in terms of healthcare provision and using new technologies, do you think that it gives Qatar a chance to move further?
Absolutely. I mean, we are, in terms of the infrastructure, one of the leading countries in the region about the digitalization and the connectivity infrastructure that we have. And we would like to really tap into this as a strength of the countries to make sure that we can attract and invest in technologies that could be part of this. Fintech, for example, is one of the pillars that central bank is taking as an initiative with the banks to make sure they could attract this type of technology here.
Dina, I'll give you the last word on AI and fintech. At Goldman, are you worried by what fintech will do, or are you optimistic about the ways you can use it?
Well, certainly I think there's going to be advancement in a number of sectors. I think the one to worry about is national security. I think that there's actually quite a few people who are extremely worried about what that means for asymmetric warfare, military investment, that sort of thing. So I think some of the focus, understandably right now, is on workforce, fintech, new innovations, journalism and how it's affected by AI, for example. I think what worries me is some of the things that we're not really thinking about at this stage, and there doesn't obviously seem to be any regulation on that, and I think that's something we have to focus on.
I think you've managed to prove as a panel that we possibly won't be replaced by machines, or at least the three of you won't. I might well be. Thank you very much to all the three of you. Thank you.
Thank you.
Thank you.
Thanks, John.
Please welcome to the stage Ken Moelis, founder, chairman, and CEO of Moelis & Company, and Rohit Sipahimalani, Chief Investment Officer at Temasek, for a conversation with Bloomberg's Haslinda Amin.
Welcome to the new normal. High inflation, higher rates, slowing growth, the end of cheap money. Add to that rising uncertainties, the looming recession, the banking turmoil, which some say has yet to play out fully. And of course, we had the debt ceiling issue in the US. All this coming on the back of a brutal 2022 where stocks and bonds lost something like $30 trillion. They say, brace for more vol ahead. Rohit, let's start with you. How much more difficult is it to make money now?
It's a tough environment. Let's take the US, for example. I mean, you've got the market pricing in 75 basis points of rate cuts by the end of the year. And at the same time, earnings are expected to rebound and accelerate upwards from negative right now in Q2 to plus 9% in Q4. Now, the Fed cutting rates when you have a reacceleration in earnings at a time when core inflation is close to 5%, it just doesn't add up. So today, the S&P is trading at about over 18 times earnings with real rates at 1.4%, almost 1.5% right now. In the decade before 2020, average multiples of 15x with real rates at 0.4%. So, it doesn't add up. I mean, there is definitely much more downside, and from a risk-reward perspective, very difficult to sort of take a positive stance there.
Talking about not adding up, Ken, I mean, we started the year saying it's going to be a tale of two halves. A more difficult first half, a better second half. It doesn't feel like it. It doesn't add up.
Well, as I said, it's a rolling half. We just keep moving that half further away. And I do think the banking crisis somewhat got in the way of what felt like a bit of a recovery in the first quarter. And to Rohit's point, the markets, I think there's a big difference between the economy and the markets. The economy, I think, still has a rough time ahead of it. But it's the job of the markets to look ahead. And the markets have sort of been in a funk for 15 or 16 months already. And I think they're itching to look beyond the 9 to 12 months that we might have a bad economy, but the markets are going to try to anticipate that and get ahead of it.
The banking crisis, some say it will take years to fully play out. Do you agree?
Yes, because this will result in tremendous new legislation and regulation. The banking crisis was almost, look, it happens every 10 or 15 years. It just happens differently. But the banks are under, we have a strong system, but they still levered 7 or 8 to 1. By definition, a bank is levered 7 or 8 to 1. And the speed with which deposits can leave now is a real problem. So it was funny, in the last crisis, I told my kids, this was 2009, I said, look, if I get hit by a bus, just remember one thing in life: never borrow short-term to invest long-term. I said, that's it. My 13-year-old daughter would say, I don't know what that means. I said, you don't have to know it now. Just remember that. And that's the heart of all these problems. You can't have deposits that can leave in a half hour and invest in assets that are of duration, and that's going to be a real problem.
So what are the implications for the US and the international banking system then?
So look, right now you're seeing a tightening in credit across most developed markets. I mean, you've had the recent bank lending survey in Europe, ECB bank lending survey, had credit conditions were the tightest you've seen since the GFC. Similarly, the loan officer survey in the US showed sort of similar characteristics. And they're at levels usually you would associate ahead of a recession. So, ultimately, this is a cyclical thing. We've got an overheated economy, inflation that's sort of struggling to come down. It's coming down, but it's still elevated, and there's no real sign of it getting to the Fed's 2% target. So in my view, a lot of this is cyclical, but we have to go through the pain to create the slack in the economy, to get inflation back under control. And we do think it won't be a severe recession, just because the starting point in terms of household balance sheets, bank balance sheets, corporate balance sheets are much better than we've seen in terms of the bad recessions.
Of course, we had Secretary Mnuchin saying that there's a 50-50 chance of a recession in the US. Pretty non-committal. Ken, do you agree?
I can't see how we don't have a recession. These rates, remember, a year ago when they started to raise rates, you only had to pay like a quarter of 50 basis point increase. We're now at the point where you have to pay a full year of a 500 basis point increase or a 400 basis point increase. So it's a slow-moving, eating away at the profits. But again, I think the economy has worse to go, but I think the markets have been anticipating this for a while.
So we've been talking about the risks. Let me just add one more, the debt ceiling. Of course, I mean, maybe a resolution will come soon, maybe not. Is there a sense that we are concerned about a possible default and what that would mean for markets?
It's a difficult one to sort of expect a default. You've seen this movie play out so many times before. It goes to the wire, and then you have some resolution.
Much worse this time round.
Look, I personally feel they'll get to a resolution. You'll get to the wire, and then there will be a resolution. So I'm not that concerned about this issue. Even if there's a default, there will probably be quick corrections out there. It's not something that's going to be a steady state going forward. So I'm more actually concerned about more structural issues that we're seeing in the global economy, particularly around geopolitics and tensions of the kind that you haven't seen in the last few decades, and the implications of that on a lot of businesses, economies, and how we invest.
Ken?
Yeah, I agree with Rohit. This is, it's a great made-for-TV drama. Maybe it's the M&A banker in me, but no deal ever happens until each party walks out at least once. And we just don't cover that. we're covering that on a moment-to-moment basis. But I think it'll be behind us soon.
Rohit talked about geopolitics. You have to talk about China, US-China in particular. They're bickering over just about everything. Is China too risky to invest right now? We know that when we had this conversation about a year ago, you were predicting that China would recover in terms of its economy in the second half of last year, but yet we saw the CSI 300 index get dumped, down 14%. The Hang Seng index was also down about 10% thereabouts. And here we are, China is looking pretty weak.
So the basis for the recovery was that they would get out of COVID and the economy would open up and consumption would recover. Through this process, you also had the elections, everything else, with the new president, I guess the renewal of the presidency, et cetera. And there were a lot of concerns around the global economy as well as in China. You saw the opening of COVID took longer, but in the first quarter of this year, you saw a sharp recovery in consumption, and the expectation was that that would continue into the second quarter. Now, what surprised everyone is that it hasn't. It's actually slowed down again. So look, at the end of the day, it is critical for the party out there to drive growth, and the only channel for growth this year is really going to be consumption. So I think it will ultimately happen, but timing is uncertain. The more important part is in terms of capital flows and what happens to the markets. And that will be driven by domestic capital flows. It's not going to be driven by foreign capital flows. And on that front, I think it's a question of consumer confidence. Savings rates have gone up. Normally, that money would have gone into property. It's not going to go into property right now. If you see that confidence come back, it will move into the domestic market. You've had the HSI had 3 consecutive years of negative returns. You've never in history had 4 consecutive years of negative returns. So this time may be different. But I do think you're starting off MSCI China trading at well below average multiples. You should see a cyclical recovery in earnings. So the question is, look, do you have a modest growth in the market this year? Or do you have, a sharp overshoot to the upside? That's what I would from a tactical and cyclical perspective, that's how I would sort of think about it.
The American perspective?
Well, I'll give you my perspective because I think it's contra to American perspective. I think America made a tremendous mistake weaponizing business and capital flows as a result of this war. I think they've put a risk, and by the way, I compliment the region's approach to this. This region has acted exceptionally, I think, smartly. But I think we've put in a risk now, a political risk on your capital investments that is digital. What happens if I need to exit? And I think that's going to have a long-term ramification for investment in certain politically hot areas where China is right now. And I think that's a problem.
The thing is, can you afford not to be in China?
Well, I think there's a lot of boardrooms in the world now asking, can we afford to be in China? Can we afford, if somebody tells us we have to walk away from our asset base, how much asset base do we want to have? What can we afford to leave behind if a political confrontation? I don't think that, I don't remember that being on the agenda in my first 30 years in this industry, and now it's definitely a conversation.
Definitely a very strong US perspective. Elsewhere too, people have to consider that risk. But I think people are trying to balance it in saying, this is the second largest economy in the world. It's the largest trading partner to 140 countries. In fact, even in European Parliament, the EU president sort of said that it's neither viable nor desirable to decouple with China. The world can't just cut itself off from China. Having said that, there will be a lot of sectors where it's going to be exposed because of these US-China tensions. So really, it's investable, but particularly in China for China, or businesses that are self-contained within the China economic sphere of influence. The markets in China, the supply chain, the technology, you're not dependent on the West. And there are a lot of sectors where that holds true for China. So I think you have to be selective where you invest in China. There definitely will be opportunities.
The question is, where is investable? If you take a look at the crackdown, they went from tech to property to now consultancy. If you take a look at the filings of Temasek, Rohit, you guys have been buying Baba, JD.com. Is there a sense that they're buys now, or do you, like you said, have to be pretty specific in terms of what you buy in China?
So as I said, you got to be policy aligned and you got to be out of the crosshairs of US-China tensions. So actually the areas that are most exciting to us for China right now are things around sustainability, so EVs, batteries, solar, wind, that sort of stuff. China is dominant and it's very policy aligned. Areas like biotech, which earlier we would have looked at the domestic opportunity, but also looked at the opportunity in other markets, in Western markets. Now you've got to underwrite it based on the domestic market opportunity, which is also very big. And you got to just, that's the only shift you got to make. Or in general consumption, whether discretionary or staples, et cetera, which are policy neutral, and China is a big market. So those are the areas which we are most focused on. Because, and again, as I said, it's, from capital flow perspective, it's going to be domestic capital flows which are going to drive it. I don't think you can rely on US capital flows, for example, to come in any significant way into China.
What looks attractive? You take a 12, 24, 36-month perspective in China.
Yeah, yes, you can, but you still, you know, if you're in, let's say, a U.S.-China investment program and you're thinking about it, you have to wonder over that time frame, will there be an event that causes that a public outcry, governmental intervention causes you to have to walk away from that investment? And it's very hard to make your money back in 36 months. I mean, you know, most investments have a long term, and that's a real risk right now. And by the way, it might be a 1 in 5 chance that it happens, but that's a significant, look at the assets that, private assets that had to be forsaken and left behind as a result of a political confrontation.
You know, the speakers before us keep talking about the opportunities in the Gulf area, in the Gulf states. They used to be the source of capital. Now they have become a very attractive investment destination themselves. What's your take on it? What's contributing to that? What's looking good?
Almost everything. When I come here, it's so energized. And I know, I was going to say, the real asset of the Gulf is energy, and I don't mean energy in the ground. I mean the energy of the people. The region has thought long term. It has invested in talent, in infrastructure. The decision making is crisp and it's clean. The ability to get workforce in here. The fact that there's you don't have to, as a business, you don't have to deal with the union problems. I think the region has so much going for it in terms of their ability to make decisions, operate quickly, cut through the red tape, and lastly, think long term. This is one of the few places in the world that's actually making investments for 5 to 10 years. They're not huddled in the White House trying to figure out if they're going to pay the debts next week. They're thinking, how do we make the country rich 10 years from now? How do we make our people better off? It's invigorating to be here.
Ken says, think long-term. Tomasik, a long-term investor.
Look, I think from our perspective, you know, you talked about risks in China, risks elsewhere, et cetera. I think you have to have a balanced portfolio which can actually do well across most environments or not be unduly exposed to a particular environment. You know, the Middle East clearly is an emerging area where there's a lot of energy, growth, et cetera, and we need to look to see what opportunities we can sort of see out here. But it has to be in the context of a global portfolio and the balance. So, you know, I just want to come back to this point you made about China and the risks there. I mean, clearly there are risks, but when we do the scenario planning, there is also upside scenarios for China. So you can't have a portfolio that just completely avoids China, just like you cannot have a portfolio that avoids the US or Europe, or in fact now increasingly, I would say, the Middle East. So I think that's how we try and look at a portfolio which is more balanced, and I definitely agree with Ken that there's a lot of energy out here, and this is one of the fastest growing regions. Also, I would say regions that are relatively not in either the US or the China camp will benefit in this geopolitical environment. So that's Southeast Asia, India, the Middle East are all, I think, going to be beneficiaries of that.
I'm wondering and curious about India. People always talk about India being the alternative to China, but there are also questions about the scale compared to China. I mean, if you take a look at the private equity market, for instance, is it ready to absorb the capital that is being diverted, rotated out of China?
I don't think it can be a substitute for China in the near term. I mean, China is 5 times the size of India in terms of the size of the economy. Having said that, both from a structural and cyclical perspective, India is looking very good right now. From a structural perspective, this China plus one strategy, India will form part of the alternative out there. There's been a lot of investment in infrastructure and other areas in the last few years, which is positioning India for growth. On a cyclical perspective, PMIs are at the highest levels you've seen in the last decade. Credit growth is strong. So it is an attractive market, and we would want to sort of do more and increase our share in that market of our portfolio. But you've got to be calibrated to how much you can do. I mean, you've got to be realistic that it's not just going to be a substitute for China, but it'll be one of the areas where you'll see more money flow in.
Ken, thoughts on India?
Yeah, look, India should be the greatest economy in the world. You know, if they get out of their own way bureaucratically. You look at the United States now, I think, I don't have it exactly, but 6 or 7 of the largest companies in America are run by Indian trained and Indian business people. The difficulty with India is those people are in America. and if they could get to decision making, get the bureaucracy out of the way, it should be exactly what you said. And they just have to solve that.
Quickly running out of time, I just want to touch on crypto. It's gone from a crypto winter to the ice age, has lost a lot of money there. What are the chances of a recovery? How are you looking at it? Is it a sideshow? Will it make a full recovery if we have regulation? How are you looking at it?
Well, we actually started a blockchain crypto group within our own firm because we think whatever happens, and I don't know the answer to that, but I know there is a whole generation that's tremendously interested in making it work and is committed to making it work at a system. And our job there will be to try to help them. We've been involved in almost all the restructurings. So far it's been a lot of cleanup around some of the projects that haven't worked. But who knows? I never underestimate the energy and the creativity of this generation. So I think it's going to have cycles, and we'll see where it goes.
Is there still appetite? I mean,
I think
Temasek was badly hit.
You know, to your point, I think regulation is going to be key, because in the absence of regulation, it's too volatile an asset to be a store of value. So I think we'll just have to see how regulations sort of come out and what that means for this asset class in the longer term.
But some say it's not a good fit for institutional investors.
I mean, right now, in the absence of regulation, given all the uncertainty, there's no fundamental value to these cryptocurrencies. Clearly, it's very difficult for institutional investors to invest in the currencies as such. Around blockchain applications, which are much beyond just the currencies, I mean, yes, I think that could be an area for investment for institutional investors, you know, where you find the right business opportunities.
On that cautious note, we wrap up this discussion. Ken, Rohit, thank you so much for your time.
Thank you for having us.
Thank you.
Please welcome to the stage David Docherty, Head of Oil and Renewable Fuels Research at Bloomberg NEF.
Thank you. Now, what is a new energy economy? A new energy economy is an ambition. In 2020, just 3% of the world's emissions fell under a net zero target. That number increased to about 30% when we took into consideration those that were discussed at a government level. That meant that 70% of emissions globally did not fall under an emissions target in January 2020. Now, if we go to January 2021, that number of emissions that were being targeted at least increased to about 55%. That meant the 45% remained to be targeted by net zero targets. Now, today, just 9% of the world's emissions do not fall under a net zero target. That is the foundation stone of a new energy economy. If you bear with me, our slides will catch up and it'll be more interesting, I promise you. So we have the ambition and we have the foundation stone of our new energy economy. So what does a new energy economy look like? Well, a new energy economy is very different to our world today. In 2021, thank you. In 2021, over 80% of our energy mix was met with fossil fuels. You might have to flick the slides for me in the background. This is not going to work either. Thank you. In 2021, over 80% of our energy mix came from fossil fuels. What does a new energy or a net zero world look like? Well, we really don't know is the answer to that. We have a bunch of scenarios that paint a picture of this world for us. What we do know is in scenarios like the International Energy Agency, the IPCC, or the NGFS, that renewables make a much bigger share of our energy mix in future. Biofuels, wind, solar, clean energy sources. But oil and gas continue to feature in the energy mix. For example, in petrochemicals used to generate plastics, and also in abated power production. What that does is it creates competition. Competition to take part in that smaller market. Competition that some are far better placed than others to take part in, be it at a lower extraction or a lower carbon emissions rate than others. That's beneficial particularly for those here in the Middle East. It also generates new markets, new technologies that require a lot of investment. Investment that increases to $320 billion each year in the 2030s in the case of carbon capture and storage, and $430 or $420 billion annually in the 2040s. It also generates completely new markets and new commodities to be traded. Markets that require, again, a lot of investment in a net zero world. So the next question is, what might a new energy economy require? There's one world and one word here that reigns supreme: capital. Supplying energy, that means bringing joules of energy out of the ground or out of the sun and sending them to the end user via pipelines or via pipelines, requires about $3.3 trillion every year. That compares to some $2.2 trillion in its previous peak. Over time, this declines, and between now and 2050, you need about $3 trillion every year in order to remain on track for a net zero world. To put that into local terms, that's about 15 Qatar World Cups every year globally by 2050. It's a very diverse opportunity, not one that is limited to solar, wind, and electricity lines. So, we know what it might look like. Can we afford a new energy economy? Yes is the answer. GDP spend, investment in energy supply as a share of GDP spend hovered at around 2% since 2005. And while it increases this decade to about 3.5%, that's about the same as the United States spends on defense each year, it still remains far lower than what is spent in most economies on healthcare, and it declines to about 1.5% by 2050. So, as you leave the Qatar Economic Forum, the question should no longer be in future can or what is a new energy economy. It should be, how can we invest to take advantage of this new energy economy? And how can we do it in an equitable way? Thank you very much.
Please welcome to the stage Ursula Burns, founding partner of Integrum Holdings and chairwoman of Teneo Holdings, Bob Moritz, global chairman of PwC, and Dato Amarul Faisal Wanzahir, managing director of Khazana Nacional, for a conversation with Bloomberg's Jennifer Zabasaja.
Nice and high.
Yeah.
You okay, Ursula?
I'm great.
You're
Yeah.
good over there. Great. So thank you all for being here with me and with the rest of the audience here. When we talk about net zero, I think there's a lot of different threads that we can pull at. But before we get into, I guess, the nitty-gritty of the discussion, I wanted to sort of get all of your assessments on where you think we're at in terms of goals set and reached? I mean,
Right.
Faisal, maybe you start giving your perspective from Malaysia.
Okay. Two things, goal set and then reach. I think goal setting, the good thing is, I think in the last COP and the year before that, there's actually been a lot of progress in terms of nations as well as corporates committing to some form of a net zero target.
Right.
So goal setting, I think that's there. I think when you look at Malaysia as an entity, and not just Malaysia, I think you look at Southeast Asia in general, that's something where the mind is all focused on trying to achieve a net zero economy of some sort. Now, are we there yet, or is there a lot more to do? That's where, you know, in a way, some people are setting goals, and we'll figure out how to get there. And that's where we are. I think some countries and some corporates are a bit more advanced in terms of being very clear in identifying how much emissions they're actually, you know, that they have to cover, how much to reduce it, what requires or some credits. Some are more advanced, but when you actually look at the whole problem that we have, it's not just large corporates, but we're talking about SMEs, we're talking about smaller players, and I think that's where, you know, there's still a lot more work.
Bob, I see you nodding your head there.
So a couple of things. While I agree there's been tremendous progress relevant to the goals that have been set, there hasn't been what I'll call a reconciliation of the goals throughout the entire system. Governments have made some commitments over here, businesses have made commitments over here, and in between the two, they aren't meeting. They aren't meeting yet. So how do you actually pull this all together so it's a comprehensive goal setting that you understand how all the different pieces of the pie come together? That's point number one. And while we've seen progress on the goal setting, what we haven't seen is the progress at any one of the levels. And the reality is, when we look at our own statistics and some of the surveys that we've done, the decarbonization that is needed has fallen behind. And we probably need to decarbonize 11 to 15 times faster than we have in the last decade to even achieve or have a sense of potential to achieve the reality of the goals in terms of the ultimate setback that we're looking at. The other piece I would say is, as we talk about these, the other thing that's got to be supportive, and the previous speaker just spoke on it, is the allocation of capital towards that. And are we getting the capital to the right places in the right ways? And are we getting the accountability right? So we have a lot ways to go in terms of the progress versus the commitments and the goals that we've set as a society at large.
And Ursula, the accountability part that Bob was just talking about, that's still, there's not a unifying agreement about what that looks like. Considering you sit across various sectors, I mean, what's your take on sort of this accountability portion of reaching net zero?
Before I get into that, I just want to comment on the two previous comments to say that I agree 100%. Right? So if you think about 15 years ago, not even 10 years ago even, we couldn't have this conversation. This conversation that there was even a goal that we could shoot for was not universally agreed or understood. The fact that certain sides believe one thing and the other side believes another thing was still really high in the rhetoric and in the conversation. We're making progress in moving that off the table. It's still there. We're moving that off the table and now getting to the real crux of the problem, which is, what should the goals be? How do we invest to get there? And one of the things that nobody mentions is that we don't have all of the technology in hand yet to get there. It's not like we can just get there tomorrow. If somebody said you had to do X or Y or Z and had this much capital, the technologies don't, in sequestration, in any kind of decarbonization technology, and how do you manage hydrogen, how do you manage ammonias, all of these things that are possibilities, we still have a lot of work to do from a technical standpoint. So I think I like the fact that there's a discussion. I kind of like the fact that there's some disagreement, because that means that we have to continue to be at the table to actually figure out a solution that serves the planet but serves all the constituents well as well.
And we also, just on that note, we heard the other day from Exxon in particular, sort of pushing back exactly on what you said. It's going to be too costly to manage a lot of these reporting structures, and also that they think it's unlikely that we'll reach net zero by 2050. I mean, what is your take on that?
Yeah, I think that there is credibility in the discussion about reporting structure, reporting requirements, driving a level of cost that's really not sustainable. I separate that from technology that we have to invest in to decarbonize our supply chain and our world in the future. That's two separate things. I think we have to invest in the decarbonization steps. You know, if you believe that the world is going to kind of continue to boil, you have to do something. And I believe that. But what we're getting a little bit caught up in is, you know, how precise, what do we count exactly? How precisely do we count it? Who's responsible for accounting it? Bob and I see each other a lot in boardrooms, and I'm on the board, audit committee of a board, and all I say is if they want me to sign on some of this decarbonization rhetoric the same as I sign on my financials, it'll be very difficult for an audit committee to do that, right? Because the exactness, the precision is not quite there yet. So reporting one thing, actually decarbonizing the supply chain another. Spend the money to do that, and let's be really careful about just throwing, you know, millions and millions and millions of dollars behind trying to get down to the last nanometer of emission.
As you think about the discussion that Ursula just went through, let me expand on it a little bit. Today, we've got examples of innovation and technologies that are not scaled sufficiently to take advantage of the opportunity and actually have the impact. That's where more investment is needed, and as well, not necessarily just investment, but change is needed in the system. So for example, when you think about some of the renewable energies or the energy sources that are out there, and the production and the supply chain that has to be altered, the access to minerals is a question mark. How much time and energy it takes to get approval to mine for those minerals is equally as problematic, candidly, as the money and the investment necessary. So you actually have to look at changes to the infrastructure, the bureaucracy, government policies and procedures, as well as then getting capital to the right place. And between these two things, then you might have a chance of getting scalability and faster innovation with scale to actually achieve the problems that we're trying to solve for. The second piece that you went to, though, Jennifer, is this accountability point. Today, we've got a series of rules and recommendations for potential rules that are out there. You have the SEC in the US, you have the EU directive that's coming, you've got a global initiative coming out, what is called the International Sustainability Standards Board. Each one of them is putting requirements on companies of all sizes to report on progress. Each one of them does it slightly differently, to Ursula's point. The problem we have right now is the intent of reporting was to demonstrate, are you making progress, and how can I compare you against somebody else? As an investor makes a decision, as a consumer makes a decision, as a former or future employee makes a decision. And if we've got this convergence of multiple different ways and lots of different data sources, you're going to confuse the audience yet again. And that's the big problem now, is that you don't have this convergence. You've got actually a whole bunch of fracturing that's happening, which adds cost, complexity at a time where you don't need it, and that money could be better placed elsewhere to actually deal with some of the other things that we've been talking about.
And it allows people who are, it allows naysayers, or people who are stepping behind, people who are not really that engaged, to have something to debate other than the facts, right? Other than the actual problem, right? The problem is, I think that we're all on a path where we know we have to decarbonize, significantly decrease carbon, right? Decarbonization may not be the ultimate, right? But decarbonize. And we're spending a lot of time debating what standard, right? In these 4 different places we have to look.
That doesn't seem to be going away anytime soon, though, as Bob mentioned. I mean, it's globally that there's different reporting standards. So how do we catch up, you know, and not fall too far behind, given all of the different directives that we're hearing?
Well, first of all, I think we have to recognize that the problem that we're dealing with, we've been using thermal energy for more than a century. And we went transition in 27 years. So the problem here is huge. Just think about it, right? So talking about accounting, talking about how to measure it, talking about how to invest in it, et cetera. I mean, quite honestly, it's you know, sometimes we can't let the perfection be the enemy of good.
Absolutely.
Sometimes we just have to move on. So when we look at transition, I mean, like it or not, it is mobilizing the capital in order that we actually put it into the right directions. So the source of energy, yes, you're talking about investing in solar, hydro, looking at the minerals for batteries. Now that, in my mind, I think is something where it's relatively mature and capital is actually finding its way in order to invest that. But you have huge other problems that we really need to talk about, because we have coal-fired plants, which continue. Now, for Asia, if you look at the youngest coal-fired plants, and this is like less than 20 years, 90% of that is in Asia. And you have a population base, Southeast Asia, you've got 650 million people, and of course there's China, there's India. The median age in Southeast Asia is 28 years old, which means that the children of today will be alive in 2100. And in 2100, that's 50 years after 2050. If the world is boiling, if we don't do anything about it, our children will experience it.
Yep.
So it's a huge problem. Let's get the capital flowing, and how do we actually transition? I'm going to talk a bit about that, if you don't mind. So how do we actually retire coal-fired plants? How do we actually encourage people in order to reduce the emission? And it comes back to pricing. How do you price capital so we attract the capital into doing something that doesn't really make money? And it comes back to carbon pricing. So here is an example where you have carbon pricing. You have CCUS, where basically if you have that technology, then you can actually have carbon credits, and people fund that. Well, if you do a CCUS, you're actually reducing emissions. But guess what? If you retire a coal-fired plant early, isn't that reducing emissions? Can't we get carbon credits for that? And then can't we actually invest that into renewable? I think these are things that I know there are gold standards looking at this, but these are really mechanisms that we really need to focus on in order to mobilize capital for what we need. Because I think, let's not perfection be an enemy of good. Let's get a move on.
Bob, where else are we seeing opportunities to mobilize capital and invest?
So let me come back to Fazl's point for a second. As you think about the transition that he described, the need, the urgency, and the scale, the problem is people are dealing with this in piecemeal. So let's step back and talk about energy transition more broadly. As you look about the demand that's going to be needed, how much energy ultimately society at large is going to require, and then again, the transformation of that in terms of its sources from brown, black to green and other aspects of it. Let's go to some of the Nordic countries, for example. The Nordic countries have actually done a fantastic job of creating wind and solar opportunities. They've done a lousy job of actually transforming the grid to transform that energy and transport that energy into the right places. And oh, by the way, if we're actually priced it through a carbon market mechanism, you would figure out a way to actually move that a heck of a lot faster and have the right infrastructure to bring that to where the need is greatest and ultimately where people could potentially benefit from it. And that's why the whole system needs to be thought about in terms of the pieces of the cogs of the wheel that have to change and be integrated. Now let me come back to capital, reporting, and now incentives and behaviors. What we find is people are looking at this strategically. You talked about the back end. That is just the back end, which is the reporting. What we're missing is the incentives and the changed behaviors. So how do we get behaviors in government to think about the whole system? How do we get changes in corporates to think about that? If you look
that
at
like the Inflation Reduction Act?
beyond that, right? So it's Inflation Reduction Act in the US and other aspects of what the EU is doing. It's even at the corporate level. Let's just take a look at the corporate level. In the EU today, we just did a survey of about 100 companies. Each one of them talk about strategically what they want to change. Each one of them is starting to report. Out of the 100, one of them had implications to incentive compensation to the management team because they didn't met the one-year commitment, around what the transition should be for that particular company. So you've got to look at the entire system of incentives, behaviors, and ultimately the capital allocation that comes from that.
Who is it that needs to look at that, though?
What's that?
Who is it that you think needs to be looking at that?
this is where the challenge is. The challenge is it's not one person.
Yeah.
It would be great if it were one person, right? I could do it if somebody wanted to. Bob and I, the three of us could get in the room.
Who do you think it starts with then?
Well, it's going to take a coalition of the well-meaning governments, absolutely, NGOs that have to line up and help, corporates for sure. We do need participation by citizens around the world because it impacts different citizens differently. But think about where that kind of stuff happens. The last time it happened was, unfortunately, we had a pandemic, and we literally had to get together. And we came together, not perfectly, but better than ever before. So this kind of coalition, thinking about a problem that seems like it's a long way away, but you just said it, People born in their 20s today are going to be alive 20 years after we hit 2050, 2030 for sure, many years after that. We have to fix this soon. So coming together in a cooperative way with all of the people that need to be represented in the room is going to be required. It's not easy to do, and it's not normal to do.
And I mentioned the IRA because there has been a lot of talk about it from President Biden. Ursula, I want to get your take on whether you think, I mean, you mentioned that it does need to be a coalition, but is the framing of the IRA sort of in the right way, in the direction that the globally that we should all be headed in?
Yeah, the IRA is not a global framing, it's a US framing. It's really important to understand that with a view to try to incorporate certain global impacts and needs. I think that the start here is laudable and strong, but not enough. We'll need more of this. And we're already in this in the IRA, arguing about the edges instead of literally, digging deep, party debates, all kinds of stuff. It is literally about technology. It's about capital. It's about funding that technology. And it gets down eventually to reporting. And I think the IRA is a good start. It's a bold start.
I will say the one thing that the IRA has done, if in fact it meets the intentions that it created, was not only to deal with the innovation and the scaling of that quickly, that should be beneficial from a climate perspective, but also beneficial from an economics perspective more broadly in terms of growth, GDP, and employability. It actually went to changing consumer behavior.
Did, big deal.
And that's a really important piece, whereas you look at the EU, for example, and what they did on the financing side through the green bond deal and the green finance structure, it really didn't go after changing consumer behavior. And that's Ursula's point here in terms of looking at the supply side as well as the demand side.
And it's interesting on the consumer behavior piece. When I first started thinking about this many, many years ago, and it was when I joined the board of ExxonMobil. I get my auditor sitting next to me, so I have to be really careful there. But I started thinking about the fact that if you did everything right from a technology standpoint and presented consumers with the option, generally they would make the right choice, right? They would say, if you incent them the right way, they follow the lead of great marketers. What was happening back then is we were not presenting them with the right set of choices, right? We made it very difficult. We're starting to see improvement here, for example, in the number of places that you can charge your electric vehicle. You could buy one, but if you had to wait hours and hours and hours and hours to get a charge, it's not an incentive. So now we're starting to get the entire supply chain, the entire value chain incorporated in such a way that we'll be able to get some speed up, I hope. I was reading an article earlier today, I was telling this to Bob, about private jets, the impact on private jets into the UK of last year. Yeah. And it was actually a kind of startling set of statistics. For this to change, right, for that behavior to change, there has to be something to drive that change in behavior, because it's just not going to happen naturally. Unfortunately, there's going to have to be something that drives it. Some legislation, some additional tax, some embarrassment, whatever it is that actually makes it valuable and viable for you to move away from that.
You said embarrassment?
Yeah, I mean, it's a great motivator, right? Just as long as any other motivators.
That's true. I want to touch on the point that I think sometimes gets missed when we're talking about this discussion, and it's the just part of it, the equity and the transition, especially for those communities that are reliant on dirty fuel. I mean, when it comes to policies, what more can we see from the government? Maybe you can speak from Malaysia's perspective, because there's a lot of jobs that are at stake, and potentially that could be made with this transition.
That's right. No, I think you're right, because at the end of the day, when we want to move as fast as possible, ultimately it's about us, about the people, society as well. And when we transition, we always have to be careful about the implications it would have on the people, whether it's suddenly you get an increase in cost of living, or you could have jobs being lost because simply we have to retire plants early. So there's all these many aspects that have to take into account. So I think in terms of policy setting, and I think this is from Malaysia, and they are looking at it, you don't do one without considering the other.
Yeah, you can't.
And it is a transition where you actually try to either retraining program, have all these programs in place, so that the whole society moves together. It's more inclusive in nature. Now, one thing which is absolutely necessary in order to do this is public awareness. If you go to the rural areas and the villages, and suddenly cost of electricity gets high, and things inflate, what do they understand? What's this thing? So it becomes very, very difficult for them to really understand why people are moving, simply because it doesn't really hit them.
Yeah.
Now, one way about this public awareness, and this is applicable to Malaysia, is to look at the implications of climate change. This year, and I've never experienced this, but this year, the Ministry of Education had a temporary halt in outdoor activities in schools because of El Nino. The heat levels, heat wave is coming, and there's actually people being affected by it. Now, when you actually see this and you see more floods happening, it's easier to comprehend. And then when you have that, I mean, unfortunately, we're experiencing disasters in order to realize that we have to do this. But that helps where everyone, the whole of society, can come in and basically make that transition. And as far as policy making is concerned, we have to move fast, but be inclusive in how we approach it.
There's one other thing, though, I do want to bring to the table relevant to government policy in dealing with this just transition. And that is the issue of the reality that we may not get there. And the world is already heating up sufficiently that you have people at risk, either because of water, flooding, over excessive heat, droughts, you name it. So the issue of mitigation, which we've talked about, actually comes back to the issue of, are we adapting quick enough as well to the realities of what we're going to deal with? Adaptation. And today, when you look at the capital allocation, I'm going to argue there's not enough capital that's going to adaptation. Most of it's going to mitigation.
Absolutely.
Yeah. Now, one of the things I will say is that you can't replace one with the other. It actually has to continue on the mitigation piece while ramping up on the adaptation piece. And to the point, how do we become more resilient? How do we think about the commercial opportunity so there's an ROI on the capital that could be there? And how do you actually leverage the lessons learned as quickly as you possibly can, country to country, place to place around the world? And what you can't do is, if you think about those spots in the world where it's problematic for flooding or heat or otherwise, is walk away from them. Yeah. Because if you're going to say, I'm going to move my plant, or I'm going to move the schools, then people are out of jobs, out of homes, and out of, candidly, their livelihood. And we leave another aspect of society behind as well. So mitigation and adaptation is another angle to that just transition that we have to be talking about much more so as we look ahead.
Absolutely. Ursula, I'll give you the last word here.
Yeah.
Are you optimistic about this?
Ooh, more optimistic than I normally am, which most people who know me know I'm not that optimistic. But I think that we are, in the last 10 years, I've seen an acceleration on this topic that is amazing. Across society, so in cities all over the place, in business for sure, and in governments around the world. And I think if we have to speed up. We cannot take 10 more years to just figure out how to report the damn thing or whatever. We can't do that. But we have to continue the conversation, and we have to, unfortunately, as you said, disasters are an amazing kind of eye-opener and awakening, right? That the more they happen, the more we realize something has to be done. So I'm optimistic that we're heading in the right direction. I'm just really concerned about how much time we really have.
Yeah, and the politics getting too in the weeds. Well, we have to leave it there. Thank you all so much for joining me, and thank you everyone for listening to the session.
Thank you.
You can go this way.
Please welcome to the stage Peter Chernin, co-founder and partner at TCG, for a conversation with Bloomberg's Caroline Hyde.
Thank you.
Let us have some fluid. Let us kick off this jet lag. Let us welcome one Peter Chernin. Of course, you know him as a key investor in the world, well, of content, really. This is about pop culture, apparently, but you've got the Chernin Group, TCG. You've also been, of course, building up content production studios. You've got North Road. But 14 years ago, you were running Fox. And arguably, biggest cable, global content provider, sports, news, media, you name it. How do you think the world of cable is currently standing up to the disruption of streaming?
I think the world of cable is unfortunately done.
Okay.
You know, it is on its way out. You know, I think it has probably declined 40-ish, close to 50% from its peak. And I don't see any scenario in which it doesn't keep going down. So.
And from that perspective, therefore, does it go down by merging, by consolidating, by people eating one another and them all getting into the streaming business?
Well, I think that they are two separate things. I think the people who are in the streaming business are already there. So I don't think you're all of a sudden going to see sort of third-tier cable channels merging and becoming streaming.
So we're done with streaming births. This is it.
I believe this is it. I believe it's too costly. The moat is too big to enter, so I don't think you're going to see lots of new players. Did you pour me some water? Thank you so much.
That's the kind of person I am. When it comes to the streaming giants, what amazes me is actually how international they are, in the respect that, are you seeing many Middle Eastern streaming companies pop up? You're someone who intimately knows this region. You know QIA, been working with them for a long time. How do you think streamers are ending up being deeply global companies and all US-based, basically?
Well, I think it is two things. One, I think it's fundamentally capital, which is they have the capital and the investment and the will to grow globally. And then secondly, I think it's a combination of two things locally, which is one is lack of investment, but two, there's also a regulatory question around this, which is streaming over the last 7 or 8 years has been allowed to grow globally with very, very limited regulatory constraints.
Okay.
And not, in my opinion, not necessarily to the better of some local territories.
Will regulation change, do you think? Could it? Will it ever be able to oversee streaming in that way?
Well, I think you'll see some regulation change growing in Europe. Growing, but weirdly, you know, they were sort of asleep at the wheel the last 5 years. I don't know. Because the one thing the Europeans historically were good at was regulation.
They still are leading the charge when it comes to thinking about AI regulation.
But they somehow didn't, but they were very strong regulators of content businesses because they were protective of their own content businesses, and they have allowed the big streaming platforms to go in there and largely take over the media businesses in each of those countries. And you know, you'll see it happen over the rest of the world unless certain areas decide we're going to do things to, I'm not sure you should try and keep them out, but you should make sure that there are certain requirements for local programming, that there are certain things that happen to protect your local programming.
So for someone like you, who is actually creating and investing in content when perhaps some of the juggernauts are pulling back on their budgets of content, is there rich opportunity in thinking about international content, not just US English language?
Well, you know, when we established North Road 9 months ago, you know, at that point, we were the leading independent television and movie producer with shows like Planet of the Apes and Ford versus Ferrari and Greatest Showman, et cetera. We had just bought what I think is the leading documentary company in words and pictures. But we said two things. We said that we want to keep investing in scripted, but we said the two greatest areas of growth we believed would be nonfiction, because it's the easiest way for those platforms to save money as they're cutting back. And we are, I think, the producer of the #1 nonfiction show in the world, which is Love is Blind.
We'll get to that in a
moment. And then the second thing we said is we believe international will grow faster than domestic. So We have just bought a Turkish production company. We're in negotiations to buy a Mexican-Spanish company. And so we are investing in international content because it's an area we believe in.
Middle Eastern?
Well, I think Turkish is, in some ways, the most prominent Middle Eastern content.
Yeah.
You know, the thing that really attracted us to Turkey was, A, it's a big country, 130 million people, good economy, but B, that their content exports extremely well both to the Middle East and to Latin America. So we thought we looked at it as an opportunity to get into the Middle East.
You brought up nonfiction and Love is Blind. Now, Netflix's dabble with live content was an interesting one about a month or so ago. And I want to get some audience participation in this moment. If you can, make sure you've got your apps open and fill in this particular question, because I'm asking whether you think streaming companies should make inroads into live programming. Should we have cultural moments, once again, how we used to a few decades ago, go and have a water cooler moment, as you do still about sports, but what about a non-fiction event? What about a bringing together of your favorite show? What about Netflix not making you just eat up all of your favorite show in a binging watch episode, but you actually stagger it? So I want to see whether you think that they should lean into live events. After,
well, to that point,
yes.
You know, Netflix has essentially done 2 live programs at this point.
Chris Rock.
They did Chris Rock, and then they did the Love is Blind reunion 3 weeks ago. The Love is Blind reunion basically broke Netflix. Netflix was down for a couple of hours, which both, A, shows you, I think, a desire to get into live, but B, shows you the extraordinary power of Love is Blind.
And the lack of, was it a naivety on Netflix's part that
well,
they wouldn't have that level of interest that would basically break the internet?
I wouldn't call anything about Netflix naive.
Okay.
I think it is extraordinarily challenging to deliver millions of live streams simultaneously, and I think they hadn't anticipated the potential size of the audience for that.
They've done it twice. Do you think them and other streamers should experiment more? Will that become?
Well, I think you've seen, you know, you've seen certainly Amazon start doing sports, the NFL. You've seen Apple starting to do some smaller live sports. But yes, I think you'll see them all do it. You know, make no mistake, this is television. If you look at the US, television is streaming. Cable is going away, broadcasting is going away. It is television. And so I think everything that you're used to in television over the past 30 years will ultimately migrate to streaming.
Will news?
News will migrate to streaming on some level. You know, you will see the CNN streaming app, you will see Fox already has a streaming app. So I think, you know, right now, essentially live programming is what's holding up linear television, news and sports. But over time, you know, the base of cable homes are now, I think, below 50 million. So only half the people in America have the opportunity to watch those things, even if they have the desire. That's down from 90 million homes.
Do you think once streaming has won out,
it has won out.
Will they be able to push prices up ever higher? Do you think that there's a limit to that? Because many would say cable is deeply expensive vis-a-vis.
I think you will see streamers continue to push their prices up. You know, Netflix has raised their prices virtually every 2 years. Disney just did a multi-dollar price increase. Yes, I think you'll see them push their prices up.
We clearly, people wanting to see more live events, more of their shows from the streaming platforms. I'm interested in your perspective of, for example, a Bob Iger, who I know you're someone who not only knows the media landscape very well, but you also know leadership very well. You know board membership very well, an expertise of yours. How do you see someone like Bob thinking about his replacement, thinking about an ESPN becoming something that they push more into streaming, looking at the assets that they have under their scope at Disney? Are you optimistic?
Well, I think in terms of his replacement, you know, it's a slightly weird thing, which is to come in and say, within 2 years, I'm out again, because most succession processes, certainly the succession processes that I've overseen, have been 4 or 5 year things. He just went through his 4 or 5 year succession process, which in his mind clearly failed. So I think there's going to be a very rushed succession process, because on some level, this time next year, they should know who his successor is. So that part I think will be very rushed. ESPN is a challenge in the following sense, which, and Bob's a very bright guy, but ESPN is getting $6+ from every cable home in America, plus advertising on top of that, to try to make the economics work of losing that, let's call it $300 million a month of affiliate revenue. That's a quick $3.5 billion. Pretty hard to replace that $3.5 billion plus the advertising money that goes with it overnight on a streaming platform. So in my opinion, there's no scenario in life in which an ESPN streaming platform is immediately as successful as the cable platform. And they have rights fees that are still up here. So it's a pretty challenging transition to get through.
It's interesting, isn't it? The dichotomy of making money, an advertising model, and ultimately a subscription model. It's one that Twitter is currently trying to decide what works for them. And I know that they're going to go under new leadership, someone who understands the advertising community well. But what have you made of subscription-based models on social media and ultimately them starting to take talent from your previous company, Fox, and building new, after, of course, Fox let Tucker Carlson go, who I'm talking about, he's now thinking about making his new career via subscriptions on Twitter. Is that lucrative, do you think, for talent and indeed for a platform?
Well, so far there's no, look, I used to be on the board of Twitter, so I know it well. So far there's no evidence that Twitter can capably raise a subscription platform. So it's nice that Tucker and Elon have announced that, but there's no evidence of it yet being successful. I do think that you will see niche subscription services, but they'll be pretty niche. Look, we owned for 6 or 7 years Crunchyroll, which is arguably the best niche subscription service. It's a Japanese anime subscription service, which we bought, is now up to, I think, about 4 or 5 million subscribers. For those subscribers, Japanese anime is life. They will do anything for it. I think there are a few things that are that critical. Could Tucker get to 4 or 5 million paid subscribers? I'm not sure. So I think the trade-off is you can certainly make a living if you're charging $10, $15 million among passionate users, but you certainly don't have anything near the reach that you used to have. And then you're making a trade-off, which is you're getting paid, you have less influence. As your influence wanes, do you still are you still likely to get paid at that level? So I think it's an interesting trade-off for so-called celebrities.
Has there ultimately been a trade-off since you left Fox and Fox News between people serving different niches, even if they're rather enormous, left versus right, different parts of society? What do you think ultimately has been the impact of that?
I'm not sure I understand the question.
Do you think ultimately we started to see, in the last 14 years, more polarization?
Yes.
When it comes to viewing and people serving those viewers?
Yes, I think you have seen more polarization. I guess what I would say is when I left Fox, Roger Ailes, who had a series of meaningful problems separate from his stewardship of the news brand, but I think was very smart about one thing, which is if you were 10% to the right, 20% to the right of everybody else, you were the de facto right-wing choice. You didn't have to be 80% to the right of everybody else. You don't win more viewers by doing that. You don't achieve anything else by doing that. And I think Roger was very smart certainly it was Fox News to that point was more to the right of the center, but it wasn't way over here. And I think what's happened is it's gone way over here. And some of that driven both on the left and the right by competition. They started getting some Newsmax competition, et cetera, which kept pushing the right. The same thing happened on the left, which is CNN, which was probably 20% to the left, started getting pushed by MSNBC. And so you had more and more polarization going on. And I do think the current media marketplace tends to reward polarization because those people are more hardcore fans. But you don't gain viewers. You end up with smaller and smaller and smaller audiences the more polarized you get. And I think in my opinion, you should ignore those fringes and sort of say, I'm going to get the bulk of right-wing people as opposed to the 20% most crazy, and the same thing on the left.
I want to finish on competition because we've got a great audience question that came about gaming. Netflix has said their biggest competitor basically is gaming and why they've analyzed that industry. Is it something you'd look at in any way? Is it something that you think with sort of media content in general has been gamified? Are we moving to more of a gaming landscape? Is it interesting to you?
Well, it certainly is interesting to us. You know, we were an investor in a large gaming company, Scopely, which just sold, believe it or not, to Saudi Arabia 2 weeks ago, 3 weeks ago. But we've been an investor in that company for 10 or 11 years. So we certainly believe in gaming and believe in its importance. As for, you know, I think Netflix's comment about gaming was largely about viewership. That, you know, I think Reed spoke mostly about that my competition is people spending my competition is about hours spent much more than there's about money. And
TikTok
and people are spending hours on gaming. Certainly gaming has influenced content just in terms of speed, in terms of sort of the way shows are laid out. The Last of Us, which was a big hit on HBO, is derived from a video game. So there's certainly...
Super Mario, the latest.
Super Mario.
I could talk to you for another 15 minutes. Unfortunately, as time tends to disappear so quickly when it comes to content, please do give a large round of applause to the one and only Peter Chernin. Thank you very much indeed.
Please welcome to the stage His Excellency Akbar Al-Bakr, Group CEO of Qatar Airways, and David L. Calhoun, President and CEO of the Boeing Company, for a conversation with Bloomberg's Francine Lacroix.
Gentlemen, thank you so much for joining us. There's a lot to talk about in aviation. Let me talk first about supply. It seems that it's a shortage, actually, of new fuel-efficient jets rather than demand that is aviation's #1 issue. I mean, that's pretty incredible. Did you see this coming?
Without a doubt, and Akbar and myself have been around the industry for a very long time. We had our COVID moment when we wondered whether there would ever be a demand for airplanes. Fortunately, the healthcare profession got us out of that situation faster than most of us expected. And then the re-ramp and the desire to travel has never been greater. And the industry is struggling with how to respond to that demand in a very significant way. And so I can see supply constraints for a very long time.
What's a very long time?
Well, in our world, you know, we have backlogs that go out 5-6 years. And so if the backlogs would suggest supply constraints that far, that means it's even further. Our job is to resolve them and increase our rates so that we can meet all the demands, but today, supply constraints sort of dictate.
Mr. Bakr, what does that mean of how you run the airline? So what does it mean for orders, and how does it change the equation going forward?
First and foremost, we have orders. We don't place it, yesterday. we place it very much in advance, and because of the supply chain constraint that my friend Dave just mentioned, we too are suffering as an airline because they need to produce airplanes, they need to get their supplies. We need to run an airplane, operate an airplane, and an airplane is very intense in spares and supplies to fly those airplanes safely. And we have a lot of constraints. We have, at times, airplanes grounded because there is lack of engine parts. Sometimes there is a lack of avionics because our orders that have been placed maybe a year ago has not been delivered as yet. And this all is the consequences of the pandemic that happened first time in a century, and we were very ill prepared. And now, because there was such long lockdowns, and people got paid for staying at home, half of them they don't want to come to work.
So what does that mean for travel demand?
Well, as you can see, the consequences of that, not only on aviation industry, but all over the industries that depend on human resources.
We saw that Ryanair order, which was quite incredible. Do you see any other orders well into like 2033? Are they just going to get longer and longer as people try and put orders in faster and quicker?
Yeah, it's demand is stimulated by two things, and it's pretty simple. First is, do people want to travel? We're all experiencing a reboom in travel, particularly with respect to tourism. Business travel's not yet back, but it is steadily progressing, and I have very little doubt that it will. So that's number one. Number two, and the thing that strikes an even bigger demand on the airplane providers, is fear that you're not going to get an airplane. So Qatar Airways has been good and has been ahead of most of the ordering patterns for years and years and years and years. This isn't a new phenomena, but not everybody is. And if you get a little bit behind, you have to place an order for an airplane 6 years later. It strikes fear, which means anybody else who wants to wait that long, I mean, all of a sudden they start lining up. And I think we have a little bit of that going on.
So do these market dynamics, were they behind the decision also to not start this all-clean new airplane that would counter the A321neo?
No, all clean as in sustainable?
As in, no, as in like new from scratch?
Oh, no. I've been in aviation for several decades. Every new airplane family, the requirement to make the billions and billions of dollars of investments is that it be at least 20%, if not 30% better than the last airplane. We will do that, but we have to prove out the technology suite that will deliver that before we design the airplane. And I think in our industry, because of some of the constraints, both in propulsion and the design of the wing, it's going to be at least until the mid-2030s before we, and in this case, I'm just going to assume my competitor, will call out that airplane.
I would like to give him some advice, but I will keep myself constrained. So I don't become very controversial.
Yes, I get lots of that advice.
What's the best piece of advice you've ever received?
You know, the best piece of advice in this industry, in my view, is to keep the medium and the long term in mind, because that's how this industry was formed. Develop, mature technologies, one step at a time, and then introduce really important, groundbreaking airplanes.
I know you give advice. What was the best piece of advice you've given, actually?
Well, you know that, like Dave mentioned, it takes a long time to develop a new type of airplane. They have just developed the 787s, they developed the 777X, Airbus developed the Neo, they developed the 350, the 330 Neos. But you know, these are all on an old technology platform. Yeah. And my advice as a CEO would be to both of them that now they need to start looking now, not wait for one to start before the other starts, to start looking at a new platform that will be sustainable and will be acceptable to the general public who are making unnecessary noise about emissions from the types of airplanes we operate today, though the general public don't realize that aviation is only responsible for 2.6% of the global emission, CO2 emissions. But we are right at the top of the criticism chain. So it is very important that both aircraft manufacturers, actually the third one too, which is Embraer, the Brazilian company, should now think about introducing something new into the industry.
Because that would make your life easier if if you're cutting emissions and there'd be more people flying, or?
Well, I don't have to worry about the life being easier for me because it will be after my time. Like he said, it will take 10 years. So I don't plan to be in this job.
Is it more expensive to be more sustainable? Does it drive up prices? Will it drive aviation prices overall?
I think it will in the interim years. First of all, we can prioritize what would achieve net zero in 2050 for large commercial airplanes. Really, the only significant contributor by way of change in technology is sustainable aviation fuel. That's the only thing that moves the needle between now and then. There will be advanced technologies, hydrogen included, that have a reasonable chance of delivering sustainable aviation in the second half of this century. And there will be a lot of development that will work toward that end. But in the meantime, and I think Akbar accurately said this, every new airplane that we or our competitors sell today, if it displaces an older airplane in their fleet, is usually 20 to 30% better on emissions. We have to continue that trend with every next airplane. But we've been on a good run. I think we'll stay on a good run. But the only thing that achieves net zero is sustainable aviation fuel.
And this is why we keep on buying new airplanes, keeping the average age of our airplane the youngest in the industry, is to keep growing, but at the same time not increasing the emission that we are producing from our airplanes. But again, I don't think that we will be able to achieve net zero emission by 2050. Everybody's talking about it, but let us be realistic. There is not enough production of sustainable aviation fuel. The hydrogen project is in its infancy. People also, they don't know what the hydrogen fuel will generate when it is flying at high altitude, what the water vapor coming out from the engines will do at high altitude when they freeze. And in addition to this, as Dave just mentioned, that the hydrogen technology will mature in the second half of this century, means after 2050, which means we will not achieve what everybody is being promised that it will happen. I am very skeptical about this.
And in terms of demand, Mr. Abakar, how do you think that will change in terms of travel for leisure, business, but also cargo?
People will travel. People will still depend on aviation because it plays such a large part of our lives that we cannot do without it for business, for leisure, for trade, for economic development. There is no other alternative than airplanes. I know that in one of the climate conferences, this Finnish young girl wanted to prove to the world that they don't need aeroplanes, that they can use a boat, and she arrived in this conference in a boat. But where did she start the journey of the boat? And how did she get there? Majority of the distance she covered was by an aeroplane, because she couldn't come that distance by a boat in the time she wanted to be there. So I don't want to criticize her, but what I'm trying to say is that we have to be realistic about this whole scenario about sustainable flights that people would take.
Okay, and I want to talk about China and also demand from China, but can you update us on the latest snarl to the 737 production? How long will that take?
Turns out to be, again, a reasonably brief and momentary delay at an incredibly inopportune time, because seasonal demand for many of our airline customers was peaking. But it probably will end up deferring maybe a month or a month and a half of production, which will be quickly recovered. So nobody likes these things when they happen, but I think it's short news.
Yeah, Ryanair was also saying that some of the MAX deliveries for the second quarter were delayed by 4 to 5 weeks.
Yes.
Is that a good benchmark of what we should
Yes, it is.
repair?
Yeah, Ryanair experienced that. I think they put it in the right kind of long-term perspective as not being that critical. But in the airline industry, you serve flyers every day, all day. You hear them when they're not happy, and
Mr. Al-Bakr, how do you see actually demand from China changing? So I know you're also adding routes to Qatar Airways.
China is a very important market, not only for Qatar Airways, but for the entire aviation industry, both for him as an aircraft manufacturer and for me as an airline. China, the demand, they just opened, and I can tell you already that not only that our airplanes out of China are absolutely packed, during COVID, it was also packed because, okay, we only could operate 2 or 3 flights a week. Now that the lockdown has ended in China, there's a huge appetite for the Chinese to travel out of China, and not only that they are paying me the fares that I'm asking due to the lack of capacity available to them, but also the amount of money they spend in our duty-free at the airport is more than any other nationality. So you can see how much potential the Chinese market has for the international aviation industry and at the same time for the retail trade all around the world where they travel.
When you look at the priorities, so I don't know whether it's, I mean, I imagine it's supply chain first, with an energy transition second. How do you look at the next 3-4 priorities for Boeing in the coming 10 years?
Priority 1 for the 2 airplane manufacturers is stability. We have to resolve the supply chain issues and the surprise associated with it. And we have to resolve it sort of once and for all. That is not a short-term job. It sounds like it might be, but I think it's going to take all of this year and probably all of next year before we can get to that moment where then we can begin to really ramp up our rates, meaning the number of airplanes we produce every month, to meet the demands of this growing customer set. So that's job 1. Sustainability is, it has been a priority. It has to remain a priority. It is not something different than the airplanes that we serve up today. As I said, fleet renewal is a critical part of sustainability. Those who can maintain young fleets and continue to update, they stay ahead of everybody, and they set the standard for emissions per passenger, per seat. I'll just, a case in point, the 777. We will introduce the last round of the 777 in 2025. Akbar, Qatar Airways has been a wonderful sponsor and customer for it, along with many other in the world. This airplane does with 2 engines what 2 former airplanes did with 4 each, 747 and the A380. And so that 777 is a major step forward in that market on both efficiency and emissions. It was a development began in the late 90s. And the final and most important version will be delivered in 2025. So it just shows, I think, the cycles, the commitment to see things through, the technologies that have to be incorporated, but that's what it takes.
We have a question from the audience, which is, David, how can we ensure that we prevent cases like MH370 disappearance, and how did that impact demand for the 777?
Well, I don't think there's any connection other than the industry's commitment for all things safety to learn and understand about everything that goes wrong, and we just experienced that in full transparency, and everybody knows. What do? The industry rallies around that to learn everything they can conceivably learn and to take a step forward on safety. in every case. And our industry's track record, Boeing's track record, I'm proud to say, always gets better. With respect to the 777, the demand is outstanding. I expect it to get more outstanding, as again, it's really the only airplane that flies in that category.
What's your
let me comment, because I read the question, and we are a big 777 operator. You cannot ask the industry or the airline what they will do so that this 777 MH case is not repeated again. Nobody knows what happened. There is no proof that there was anything wrong with the aeroplane. So any type of aeroplane, it be a Boeing or an Airbus, you cannot really know until you find out the data recorders to what happened. So it is really impossible. 777 is a very safe airplane. We fly with absolute zero incidents, leave alone talking about accident. So it is a very difficult question for the public to know, because there is no evidence that there was a malfunction of the airplane.
Yep.
Gentlemen, thank you so much for your time today.
Yeah,
thank you very much.
Appreciate it. Appreciate it. Thank you. Thanks.
Thank you so much.
Congratulations, you made it to the end of the day. But we have plenty more ahead. We have come to the end of today's session. It's been such an informative day of wide-ranging discussions, debates. We would like to thank our official partners, Ministry of Commerce and Industry and Media City Qatar, our presenting sponsors, Qatar Investment Authority, QNB and QRDI Council, and of course, participating sponsor QInvest. We do invite you to join us for our breakout briefings that will take place shortly in the Fairmont Hotel. Event staff are available to guide you. The future of foreign direct investment in challenging economic times, that's happening in breakout room 1. Disrupting healthcare, the radical changes shaping the biomedical industry will be taking place in breakout room 2. And don't forget, tomorrow's sessions begin 8:30 a.m. Additional 2 breakout briefings in the hotel as well. Uncharted territory, rerouting trade strategies and systems. That's taking place in breakout room 1. Game changer, transforming sports for a digital world, breakout room 2. Right. We look forward to seeing you back here tonight, 6:45 p.m. for the gala dinner. We ask that you now please do exit the ballroom, move to the networking area. Thanks again. See you soon.